All right, diving in today, folks. We're going deep, deep into the bedrock of investing.
We are. We're talking security analysis, the 6th edition.
Yeah, this is like going back to the source, back to the wellspring with Graham and Dodd.
With some really great additional commentary, too.
We've got Warren Buffett's thoughts, Seth Klarman, James Grant.
The best minds in value investing.
And for those of you who want to get smart on this, and quickly,
This is your fast track.
this is it. All right, so we've got a lot to cover, right?
A lot. We're talking about the core ideas, the techniques for analyzing different investments.
Different investments, bonds, the more speculative stuff, too.
Absolutely.
We'll even get into how to really tear apart a company's balance sheet, see what's really going on.
All that.
But our mission here isn't just, to give you a book report on this classic,
No.
right? We want to get to the timeless, the durable. What are the principles of value investing that are in these pages? How can you put them to work? We want to give you that critical eye to see through all the noise out there.
We do. There's so much information. It can feel overwhelming.
It really can. And this stuff, it was written almost 100 years ago.
I know, but it's still relevant.
Incredibly relevant in today's market. Look how complex things are.
Exactly.
All right, so let's talk about this enduring power of security analysis. Warren Buffett, one of the all-time greats, has said it's still hugely valuable.
Immensely. He calls it a roadmap.
For all of his decisions, business and investing.
All of them. That says a lot.
It does. It really does. So when we talk about a roadmap,
Yeah.
where specifically, do you see that roadmap being used today by someone like Buffett? Are there one or two examples of how this thinking shows up in the real world?
I think a really clear one is that focus on intrinsic value. The idea of buying something for less than it's worth, that dollar for 50 cents idea, you see that all the time with Buffett, especially when he's buying entire companies.
Right.
And then, of course, there's the margin of safety.
Oh, yeah, that's crucial.
It is. Think of it this way. Let's say you're buying a used car, right? You know it's worth, say, $10,000, but you manage to get it for $7,000. That $3,000 difference, that's your margin of safety.
Even if you find a few things wrong, you're still good.
Exactly. Buffett does the same thing, but with companies. He figures out what he thinks a company's worth, and he doesn't buy unless the price is significantly lower. It gives him room for error.
That car analogy, I think, really helps people understand that. It's about not needing everything to be perfect.
Right, you've got some cushion.
So value investors also have a very specific way of looking at their investments.
Right. Totally. It's not just about ticker symbols on a screen.
No, it's not.
They see themselves as owners. Even if they just have a few shares. Or as lenders if they're buying bonds. It's about understanding the real business behind those investments.
And that's a real mindset shift for a lot of people.
It is. And Graham and Dodd are very clear about this. If you're thinking about buying even a tiny piece of a company, analyze it like you're buying the whole thing. Don't get caught up in the short-term market swings. Focus on what that business is actually doing.
And then they've got this brilliant way of explaining how to think about the market itself.
Oh, you mean the voting machine versus the weighing machine?
That's the one.
Yeah, that's a classic.
So explain that to us.
Okay, so in the short term, the market's like a voting machine. Prices go up and down based on popularity, on sentiment. A company gets some good press, everyone piles in, the stock goes up, even if the business itself hasn't really changed that much.
It's like who's getting the most votes in a popularity contest.
Yeah, exactly. But over the long term, the market's more like a weighing machine. The true value of a company, its earnings, its assets, its ability to generate cash, that's what determines its price in the end.
So short term, it's all about the hype, the fear, the emotions driving those votes.
Right. But eventually, the actual weight, the real value of the business, that's what matters. Value investors use this distinction to see through the noise and find opportunities where the market's voting machine has gotten things wrong.
Where price and value have gotten out of whack.
Precisely.
And this was all developed, in a very specific time.
Oh, absolutely.
Right. It's important to remember that.
It is. Graham and Dodd were writing after the Great Depression.
Huge market volatility.
Huge. They saw firsthand what happens when speculation runs wild. Their goal was to create a system for investing that would help people avoid those pitfalls, no matter what the economy was doing.
It's about safety, about intrinsic value.
Yes.
Timeless principles.
Exactly.
And what's amazing is how relevant this stuff still is. Think about how much the financial world has changed.
It's unrecognizable.
Completely. They couldn't have imagined the tech sector as we know it.
I know, right? There's nothing security analysis about valuing a software company or a social media platform.
But the core principles, they still hold up.
They do. Understanding the business, analyzing its financials, buying at a discount, those things still matter. We might use different tools and metrics today, like free cash flow.
Oh yeah, free cash flow, that's a big one.
It is.
Why is that such a key metric for value investors now?
Well, Graham definitely looked at earnings and dividends. Those are important.
Right.
But free cash flow has become really important because it's a more accurate picture of a company's financial health. Think of it as the cash a business has left over after paying for everything it needs to operate and invest in its growth.
It's the money that you can actually use.
Exactly. They can give it back to shareholders, invest in new projects, whatever they want. Reported earnings can sometimes be manipulated with accounting tricks, but free cash flow is harder to hide.
It's a truer measure of the cash they've actually got.
Exactly.
And value investors, they're not always fans of, the mainstream financial theories.
No, not always.
Modern portfolio theory, MPT.
Right. They're very skeptical of that.
So why is that?
Well, MPT says you can only get higher returns by taking on more risk.
And value investors disagree.
Completely. They believe you can find great returns while actually minimizing risk by buying things for less than they're worth. They look at their own track record, which often shows better returns with less volatility, and they say, well, that doesn't fit with what MPT is telling us.
Seth Klarman, he said that a lot of the assumptions of MPT, like perfectly efficient markets,
Yeah.
just don't hold up in the real world.
He has. There are always inefficiencies to be found.
So the real secret to investing, according to this school of thought, isn't really a secret at all.
Right. It's funny, Seth Klarman actually said, the real secret to investing is that there is no secret to investing. It's all out there. It's been out there since 1934 when Graham and Dodd published security analysis.
So why isn't everyone doing it?
Because it's hard. It takes discipline. Most people get caught up chasing the next hot stock, trying to get rich quick. They get scared when the market drops and they sell at the worst possible time. Value investors stick to their principles, even when it's tough.
It's about emotional discipline as much as anything else.
Absolutely.
Now let's get to a really important distinction that Graham and Dodd make. Investment versus speculation.
Okay, yeah, that's fundamental. They define investment as putting money to work after careful analysis with the goal of preserving your principal and getting a decent return.
Safety first.
Exactly. Speculation, on the other hand, is all about taking big risks to try and make a lot of money quickly. Analysis might play a small role, but it's mostly about betting on market trends or just luck.
So how does analysis fit into each of these?
For investment, it's essential. You're stacking the odds in your favor by doing your homework. You're minimizing the role of chance. With speculation, analysis is less important. It's more like gambling. You're relying on things you can't control.
So with investing, you're trying to reduce risk through careful evaluation.
Right. With speculation, you're embracing risk, hoping for a big payoff.
And this security analysis, this detailed, careful analysis, it serves a really important purpose.
Absolutely. It's not just about finding companies or industries that seem promising.
It's about the price you pay.
Exactly. You could have a fantastic company, but if you pay too much, it's a bad investment. The same goes for the terms of the security, whether it's a stock or a bond. You have to analyze those carefully.
Even a great company at a crazy price is still a bad investment.
Absolutely.
And when we're talking about this analysis, Graham and Dodd are clear that you have to look at both the numbers and the less tangible, qualitative aspects of a business.
Right. You need both the quantitative and the qualitative. The numbers tell you about the past, about the company's current financial health.
The balance sheet, the income statement.
Exactly. But the qualitative stuff gives you clues about the future.
Things like management quality.
Yeah, the competitive landscape, the potential for disruption, those kinds of things.
And those qualitative factors, they can completely change your assessment.
Oh, absolutely. You could have a company with great financials, but if their business model is dying or their management is shady, that's a huge red flag.
They warn against putting too much faith in future earnings projections.
They do. The past is fact. The future is just a guess.
Even a well-educated guess?
Exactly. So use the numbers, but also think about the bigger picture.
Now let's talk about information. We live in a world of information overload.
I know, it's crazy.
Compared to Graham and Dodd's time, it's night and day.
Back then, investors struggled to get even basic information about companies.
Wait, now.
Now we're drowning in it. Financial statements, news articles, analyst reports, social media chatter, it's everywhere.
So the challenge isn't finding information.
No.
It's filtering it.
Exactly. You have to be able to separate the signal from the noise. Find the stuff that's actually useful, accurate, and important.
What to focus on, what to ignore.
It's a crucial skill.
All right, let's talk about intrinsic value. This is a really important concept for value investors.
It's at the heart of it all. Intrinsic value is what a security is actually worth, regardless of what the market says. It's based on the company's fundamentals, its future prospects, its management.
And they compare the market to a voting machine.
They do. In the short term, the market is driven by sentiment, by people's opinions. Prices go up and down based on those votes. But intrinsic value is more like a weighing machine. It's a more stable, long-term assessment of what the company is really worth.
So how do you figure out this intrinsic value? Is there a magic formula?
I wish. It's not an exact science. You have to make judgments, estimates based on the information you have. The example of Case common stock back in 1933 shows this really well.
Tell me about that.
So analysts at the time had a wide range of estimates for Case's intrinsic value.
How wide?
I mean, we're talking $30 per share to $130 per share, a huge range. But even with that uncertainty, if the stock was trading at, say, $10, you could be pretty confident it was undervalued.
It's about finding that gap, that margin between the market price and your estimate of intrinsic value.
Exactly. When the market's voting machine has pushed the price way below what the weighing machine says it's worth, that's when value investors get interested.
That's when they see opportunity.
Precisely.
All right, let's talk about some specific types of investments, starting with the more conservative ones. Bonds, fixed income investments.
Okay, good place to start.
Graham and Dodd were very focused on safety here.
Especially for individual investors, yeah.
So what were their key principles for bond investing?
Well, they had this idea of buying on a depression basis, meaning only invest in bonds of companies that could survive a major economic downturn. They wanted to see a proven ability to weather the storm.
They weren't just chasing yield.
No, they wanted safety first and foremost. They set very strict standards for bond eligibility.
They didn't want companies that were loaded up with debt.
Absolutely. Too much debt makes it harder to repay, increases the risk of default. And they also advocated for ongoing scrutiny of bond holdings. They recommended checking up on the issuer's creditworthiness at least quarterly.
So not just buy and hold.
No, you have to stay vigilant, make sure your bonds are still safe.
Active management. What about high-yield bonds? Those are often seen as riskier, but with higher potential returns.
Right. They were pretty skeptical of those, especially for the average investor.
They didn't think the higher yield was worth the risk.
For most people, no. They felt that the potential for losing your principal outweighed the extra return. If you are going to invest in high-yield bonds, they said you absolutely had to diversify.
Don't put all your eggs in one basket.
Exactly. Spread your risk across many different issuers. And in uncertain times, they generally advised sticking to senior secured bonds.
The ones with the first claim on the company's assets if things go south.
Exactly.
What about when analyzing the bonds of specific types of companies? Public utilities, railroads, industrial firms. Did they have specific metrics they looked at?
They did. One key metric was earnings coverage of fixed charges. Basically, how many times over could the company's earnings cover its interest expense?
So a measure of how comfortably they could make their debt payments.
Exactly. And they even suggested minimum ratios for different industries. For example, for a public utility bond, they might look for earnings that cover fixed charges at least 1.75 times. For a railroad bond, maybe 2 times or more. And for industrial companies, which can be more cyclical, maybe even 3 times fixed charges.
So a bigger cushion for the more volatile industries.
Yes.
It does. Now let's talk about preferred stock. How did Graham and Dodd view that as an investment?
Okay, so preferred stock is kind of in between bonds and common stock.
It pays a dividend, but it doesn't have the same voting rights as common stock.
Right. And they pointed out a big risk with non-cumulative preferred stock.
Which is?
With non-cumulative preferred stock, if the company misses a dividend payment, they don't have to make it up later. So if the company's struggling and they stop paying their common stock dividend, the preferred dividend usually gets suspended too. It's not as safe as some people think.
So you have to be careful with those.
You do. They also discussed guaranteed stocks, where another company, usually a stronger one, guarantees the dividend payments.
So it's like a bond backed by another company.
Exactly. But the value of that guarantee depends entirely on the guarantor's financial strength and their willingness to pay up.
So you're really analyzing the guarantor more than the company that issued the stock.
Right.
What about real estate bonds? Those were pretty common back in the day.
They were, and Graham and Dodd were very cautious about those.
Why?
Well, they often saw inflated appraisals used to justify the size of the bond issue.
So the underlying properties weren't actually worth as much as they claimed.
Right. And they also warned about the guarantor companies in real estate because their fortunes were often tied to those same properties.
If the real estate market crashed, the guarantors could go down with it.
Exactly. So they saw a lot of hidden risks in that area.
It sounds like there are a lot of pitfalls for investors.
There were.
And speaking of protecting investors, what do they say about the protective covenants in bond indentures?
Those are really important. They're basically clauses in the bond agreement that are designed to protect the bondholders. Like restrictions on issuing new debt that would rank higher than the existing bonds. Limitations on how much total debt the company can have. Requirements to maintain a certain level of working capital. These covenants are there to give bondholders some recourse if the borrower starts to struggle financially.
So there's safeguards to try and prevent things from going too far south.
Exactly.
And if a company did default on its bonds, what did they say about the remedies available to bondholders?
Well, they pointed out that the bankruptcy laws had changed in 1933.
How so?
The focus shifted from foreclosure, which was often disruptive, to reorganization.
Trying to salvage the company.
Exactly. So under this new system, you could have a plan to restructure the company's debt, maybe change how it operates. And if a majority of creditors and stockholders approved it, along with the bankruptcy court, it became binding on everyone.
So a more structured approach to try and preserve value.
Right.
Let's move on to a category of securities that Graham and Dodd called securities with speculative features.
Okay, interesting.
And a prime example is convertible bonds.
Convertible bonds, yeah, those are unique.
They are. So explain what those are and why they fall into this category.
So a convertible bond is like a regular bond, but it gives you the option to convert it into common stock.
So you have the safety of a bond, but also the potential upside of a stock.
Exactly. That's the speculative part. If the company does well and the stock price goes up, you can convert your bond and participate in those gains.
Sounds like a pretty good deal.
Well, it can be, but you have to be careful. There are a lot of factors to consider.
Like what?
Well, first, you have to look at the conversion terms. How many shares do you get for each bond? At what price can you convert? When does the conversion option expire? All of those things matter.
Right. Right.
And then, of course, you have to analyze the underlying stock itself. If the stock price isn't expected to go up significantly, the conversion option might be worthless.
So you're really evaluating two investments in one.
Exactly. And Graham and Dodd pointed out that the potential profit from a convertible bond is usually less than what you could make by just owning the stock.
Because you're giving up some of that upside potential for the safety of the bond.
Right. You're getting downside protection, but limiting your potential gains. They also mentioned the possibility of sliding scale conversion prices.
How's that?
That means the conversion price might change over time, usually going up. So the longer you wait to convert, the fewer shares you get. And sometimes the company can even suspend the conversion privilege under certain conditions.
So there's a lot of complexity there.
There is. It's about weighing the trade-offs, the smaller risk versus the smaller potential reward, and deciding if the convertible makes sense for you.
All right, let's talk about the balance sheet. This is a fundamental financial statement.
It is. It gives you a snapshot of a company's financial position at a specific point in time.
Assets, liabilities, equity.
All of that. And Graham and Dodd spent a lot of time on balance sheet analysis.
They did. They talked about book value, for example.
Right. Book value is basically the company's net worth. What's left over after you subtract all the liabilities from the assets.
But they also cautioned against taking book value at face value, didn't they?
They did, especially when it came to preferred stock. The stated book value of preferred stock might not reflect its true liquidation preference.
So what it's actually worth if the company goes belly up.
Exactly. The example of Island Creek Coal shows this really well. Their preferred stock had a much higher liquidation value than its stated book value. You have to dig deeper, understand the details.
They also placed a lot of emphasis on current assets.
They did. Current assets are things that can be turned into cash quickly, like cash itself, accounts receivable, inventory. They argued that the value of current assets could give you a rough idea of a company's liquidation value.
What it could be worth if you had to sell everything off quickly.
Right. And they found it strange that sometimes a company's stock would trade for less than its net current asset value.
Meaning the market was essentially saying the operating business was worthless.
Exactly. And they thought that was illogical. They said either the market was wrong Or the company should just liquidate and give the cash to shareholders.
Because the shareholders would get more than the current stock price.
Precisely. And this kind of situation should raise red flags for both investors and management.
Investors should be asking, why is this happening?
And management should be explaining themselves or taking action to unlock that value.
They also talked about the relationship between stockholders and management in these situations.
They did. They questioned the assumption that management always acts in the best interests of the shareholders.
They pointed out that management can have conflicts of interest.
Absolutely. Their own jobs, their compensation, their reputations, those things can influence their decisions. They also talked about share buybacks.
Companies buying back their own stock.
Right. They said buybacks can be good if the stock is undervalued, but they can be bad if the company overpays.
So even seemingly shareholder-friendly actions need to be scrutinized.
Absolutely.
All right, let's move on to the income statement.
Okay, the income statement shows a company's revenues, expenses, and profits over a period of time.
It tells you how much money they made or lost.
Exactly. And Graham and Dodd said past earnings can give you some insights into future earning power.
But they also cautioned against relying too heavily on past trends.
They did, especially for companies in declining industries. The example of U.S. Steel's earnings from 1923 to 1932 shows this. Their earnings fluctuated wildly from year to year.
Past performance is not always indicative of future results.
Right. And they also emphasized the importance of qualitative factors when assessing future earnings.
Things like the company's competitive position, their ability to innovate.
Exactly. You have to understand the business, not just the numbers. They also talked about the concept of earning power, which is a more normalized, sustainable level of profit.
Not just a one-time spike in earnings.
Right. And they were pretty critical of price earnings multiples, those ratios that people use to value stocks.
They suggested a general rule of thumb.
They did. They said don't pay more than 20 times average earnings for an investment.
So even if a company's making money, there's a limit to how much you should pay.
Precisely. And they also pointed out all sorts of ways that reported earnings can be misleading or distorted.
Accounting tricks, one-time gains or losses, inconsistencies in how they account for expenses.
All of that. They gave a bunch of examples, like Manhattan Electrical Supply, which inflated its profits through a one-time asset sale, and companies like American Sugar and American Car and Foundry, which use different depreciation methods.
So you have to be careful with the numbers.
You do. You have to understand the accounting, make sure the profits are real and sustainable.
They also had a section on low-priced common stocks.
They did.
Right.
They found that sometimes you could find stock selling for less than the value of their net current assets.
So even in the bargain bin, there could be hidden gems.
Exactly. It's all about finding those overlooked opportunities.
Finally, while their focus was mainly on the U.S. market, they did touch briefly on global value investing.
Right. They acknowledged that the principles of value investing are applicable globally.
But they also said there are additional challenges when investing overseas.
Absolutely. Things like currency fluctuations, different accounting standards, political and economic risks. Thomas Russo's commentary in the 6th edition has some great insights on this.
So the principles are universal, but the application can be more complex.
Exactly.
Well, this has been a really deep dive into security analysis. A lot to digest.
A lot.
But let's recap some of the key takeaways for our listeners.
The core principles are timeless. Margin of safety, thinking like an owner, thorough analysis, intrinsic value, disciplined approach to speculation. These things still matter.
They do. And for you, our listeners, we hope this has given you a framework for thinking about your investments.
We want you to approach your decisions with confidence, with a critical eye.
Don't be afraid to question things, to dig deeper.
And remember, this stuff isn't just for professionals.
No, it's for anyone who wants to be a smart investor. And on that note, here's something to think about. We live in a world of rapid change, technological disruption, global interconnectedness. How do these principles, developed almost a century ago, need to adapt to this new reality?
What are the new sirens of speculation that are tempting investors today? How can we use the wisdom of Graham and Dodd to navigate this new landscape?
Some great questions to ponder.
They are.
We encourage you to read security analysis for yourself.
And check out the commentaries in the 6th edition.
They offer some really valuable insights.
They do.
Thanks for joining us on the deep dive.
It's been a pleasure.